The stock market is a platform where investors buy and sell shares of publicly traded companies. When a company decides to go public, it offers shares of its ownership to investors through an initial public offering, IPO. These shares are then traded on stock exchanges like the New York Stock Exchange, NYSE, or the NASDAQ. Stock prices fluctuate based on supply and demand, economic factors, company performance, and investor sentiment. Investors aim to profit by buying low and selling high, while companies use the stock market to raise capital for growth and expansion. So, the stock market is essentially a marketplace for buying and selling pieces of companies. Now, let's get into the first key concept: market orders and limit orders. In the bustling world of stock trading, there are two main types of orders you can place: market orders and limit orders. A market order is like an eager beaver, ready to dive in. It's an order to buy or sell a stock immediately at the best available current price. But remember, the key word here is current. The price you see when you place the order may not be the price you get, as stock prices can change rapidly. On the other hand, a limit order is more like a patient owl, waiting for the right opportunity. It's an order to buy or sell a stock at a specific price or better. If the stock doesn't reach your specified price, your order won't be executed, so it's all about precision. So market orders are about speed, while limit orders are about price. Next up, we're going to explore volatility and market capitalization. Delving into the realm of the stock market, one term that often comes up is volatility. Simply put, volatility is the rate at which the price of security, in this case a stock, increases or decreases for a set of returns. It's a measure of risk. High volatility means the price of the stock can change dramatically over a short time period in either direction. On the contrary, low volatility means that a stock's price does not fluctuate dramatically, but changes in value at a steady pace over a period of time. It's like sailing on a calm sea versus battling stormy waters. Remember, this can impact your investment performance and the level of risk you're taking on. Now let's turn our attention to market capitalization. Think of this as the total value of a company in the stock market. It's calculated by multiplying the total number of a company's outstanding shares by the current market price of one share. This is significant as it helps investors to classify companies into different sizes: small, mid, and large cap. For instance, companies with a market cap of over $10 billion are typically considered large cap companies. Understanding market capitalization can help you diversify your portfolio and manage risk more effectively. Remember, volatility represents risk, while market capitalization represents size. Moving on, let's understand earnings reports and initial public offerings. First, earnings reports. Picture these as a company's report card. They're released quarterly and annually, and they provide a detailed look at a company's financial performance. These reports contain key metrics like revenue, expenses, net income, and earnings per share. They're a bit like peering under the hood of a car. They can reveal whether a company is firing on all cylinders or if it's stalling out. For example, if a company consistently posts strong earnings, it's a good sign that they're financially healthy. On the contrary, a string of weak earnings could indicate underlying issues. Investors and analysts often use these reports to make informed decisions about buying or selling a company's stock. Next up, initial public offerings, or IPOs. An IPO is when a company sells its shares to the public for the first time. It's like a debutante ball for companies. This is a significant event because it allows companies to raise capital and gives regular investors the chance to take part in a company's growth story from the get-go. For instance, imagine a tech startup that's developed a revolutionary new app. They decide to go public through an IPO, allowing you and other investors to buy shares and potentially profit from the company's future success. So, in a nutshell, earnings reports reveal a company's financial health, while IPOs mark a company's entry into the stock market. Now, let's delve into regulatory bodies and market trends. In the world of stocks, regulatory bodies play a critical role. They're like the referees in a game, ensuring that every player follows the rules. One such body is the Securities and Exchange Commission, or the SEC, which oversees the stock market in the United States. The SEC's job is to protect investors, maintain fair and efficient markets, and facilitate capital formation. It's their responsibility to ensure that companies are transparent with their financial information and that trading is conducted in a fair and orderly manner. While regulatory bodies set the rules, market trends are the currents that move the game. These trends reflect the overall direction of the market, be it upward, downward, or sideways. Within these broader trends, There are also sector rotations, which involve shifts in investment from one industry to another. For instance, investors might move their money from technology stocks to healthcare stocks based on various factors such as economic conditions, government policies, or technological advancements. Comprehending market trends can provide significant investment opportunities. For example, recognizing a trend towards green technologies early on could have led investors to companies like Tesla or NextEra Energy, reaping substantial rewards. In conclusion, the stock market's landscape is shaped by both regulatory bodies and market trends. Regulatory bodies ensure fair play, while market trends provide investment opportunities. Let's talk about stock splits, mergers, and the benefits of long-term investing. Stock splits and mergers are two key events that can significantly impact your stock holdings. Let's start with stock splits. Imagine you have a pizza cut into 4 slices. If you decide to cut each slice in half, you now have 8 slices. But it's still the same pizza, right? That's essentially what happens in a stock split. A company decides to divide its existing shares into more shares. But like the pizza, the total value of the company remains the same. So if you owned 1 share before the split, you might own 2 or more shares after, but the overall value of your investment hasn't changed. Now let's move on to mergers. A merger is when 2 companies decide to combine into one entity. As a shareholder, you might see your shares in one company transformed into shares in the new merged company. The value of these shares will depend on the terms of the merger, and it could be more, less, or the same as before. So while stock splits don't inherently change the value of your investment, mergers can. Now, on to long-term investing. Picture this: you're on a boat in the middle of the ocean. If you focus on each wave, the ride can seem incredibly turbulent. But if you look at the horizon, the ups and downs smooth out. It's the same with long-term investing. Short-term market fluctuations like those waves can seem daunting, but over time, these fluctuations can balance out, and the overall trend of the market is upward. One key strategy for long-term investing is diversification. Instead of putting all your eggs in one basket, you spread your investments across different types of assets. This reduces your risk and can lead to more consistent returns over time. To sum up, stock splits and mergers can change your stock holdings, but long-term investing often balances out short-term market fluctuations. So, keep your eye on the horizon and remember, investing is a marathon, not a sprint. Finally, let's explore the psychology of investing and some real-life case studies. Diving into the human side of investing, we encounter fascinating behavioral finance concepts like investor sentiment and herd mentality. Investor sentiment, quite simply, refers to the overall attitude of investors toward a particular security or financial market. It's what drives demand, and by extension, market prices. When sentiment is positive, prices tend to go up, and when it's negative, prices typically fall. Now let's talk about herd mentality. It's a phenomenon where investors follow what they believe others are doing rather than their own analysis. In other words, it's when people get swept up in the market's mood, whether that's a buying frenzy or a selling stampede. But beware, just because everyone is doing it doesn't mean it's the right move. Let's bring these concepts to life with a couple of case studies. Remember the dot-com bubble of the late 90s? That's an example of extreme positive investor sentiment. Everyone was so excited about the potential of the internet that they drove tech stock prices sky high, often without considering the underlying value of these companies. On the flip side, consider the financial crisis of 2008. Fear and uncertainty led to negative investor sentiment and a severe sell-off in the market. This is an example of herd mentality where investors followed the crowd in a mad rush to sell, often to their detriment. These historical events underscore the importance of maintaining a level-headed approach to investing. It's essential to base your investment decisions on sound financial analysis and not get swept up in market euphoria or panic. Investing isn't just about numbers and trends, it's also about understanding human behavior. To wrap up, let's quickly revisit what we've learned today. We've covered the basics of the stock market, from the differences between market and limit orders to the significance of market capitalization. We've examined earnings reports, IPOs, and the roles of regulatory bodies. We've also explored the implications of stock splits and mergers, the benefits of long-term investing, and the psychology affecting investment decisions. Remember, understanding these concepts is the first step to navigating the stock market with confidence.